On today's Hot Sheet, I'm discussing the Fed's economic outlook and housing price dynamics, Millennial and Gen Z mortgages, and investor home purchases. Today is Tuesday, May 21st, 2024. I'm Byron Lazine, and the Hot Sheet starts now. Good morning. Welcome into today's Hot Sheet. Let me know in the live chat which market you're tuning in from. Happy to be back up in my Connecticut studio here as we kick off this Tuesday. We're going to kick it off with some Fed news. Vice Chair Philip N. Jefferson spoke at the Mortgage Banker Association Secondary and Capital Markets Conference. Long name. They love these financial guys, love these really long names for their conferences. It's a conference and expo in New York here recently. I think it was just yesterday. So anytime the Fed talks, this is again one of the members of the FOMC. Anytime they talk, we want to listen and see if we can gain anything out of it. Okay. He made sure to put a disclaimer on this conversation. You'll see the disclaimer in your BAMX Hot Sheet show notes. The views expressed here are my own and not necessarily those of my colleagues on the Federal Reserve Board or the Federal Open Market Committee. So making it clear, separating himself. But as we go over these are a little bit generalized, and I think kind of puts a stamp on some of the things that they've been saying. It's important for us to kind of cover where their mindset is from week to week if they do talk. Another interesting, before I get into exactly what he said here at the expo in New York, another interesting piece of information I saw this morning, and it was about the UK inflation rate. Okay, that they're going to be coming out with their updated inflation numbers, I believe, this week, and the expectations are that they're going to go from 3.2%. Their Fed target is also 2%. Okay, go figure that they've got the same Fed target as us. That they're going to be dropping from 3.2 all the way to 2 or 2.1. That's the expectation right now where they're going to hit. So that's a huge jump. This is Britain. Okay, Britain's inflation rate could be about to drop below the Bank of England's 2% target. So even below 2%. Economists see the UK inflation print, which is coming out tomorrow, taking the headline rate near or even below the Bank of England's 2% target. This is largely due to energy prices. So their energy prices fell sharply in April. Markets remain divided on the chance of a June interest rate cut. This is for their UK. Okay, so inflation could be about to hit a major milestone, but they got a 2% target just like we do. This is a plunge from the current level of 3.2%. This could make or break a June interest rate cut decision. They've said prior in the UK that they're going to cut sometime in the summer. We haven't gotten that type of an indication here in the US. Here's why I thought this was particularly interesting. Remember the Wall Street Journal article I talked about last year, where they did a study on how they are looking at inflation, their inflation metrics, what we look at with CPI. What we look at with CPI includes that made up, make-believe, pie in the sky, phony survey number, which is owner's equivalent rent. They do not have that here. Okay. They don't take into consideration owner's equivalent rent because it's a make-believe number. It's not based in real data. It's based on homeowners' feelings. It's a nice thing to look at as a survey or a sentiment report, but we weight it 26% of total CPI, which is just mind-boggling to me. They don't do that over the pond, okay? So they're going to drop now from 3.2 down to 2%. If we were going to have a report that dropped us down to 2%, you'd see investors, you'd see the market screaming, Jerome, you got to cut, because if you drop down too far without cutting, you've heard Jerome Powell say this, like, we're going to cut leading into getting into 2%. We don't want to wait to 2% because then you risk stagflation. And they definitely don't want that. So they're going to try to start cutting before they get to 2%. Now, it looks like in the UK, they're going to hit 2% based on this report. And then they're going to be faced with, okay, now how much do we cut to try to catch up and get even so we can maintain 2% and not drop too low. Assuming that they, like the U.S., want to stay at their target, which would be 2%. They don't want to drop below it. So for them, energy had a big driving. They already don't have owner's equivalent rent. If you took owner's equivalent rent out of how we measure CPI today, we'd be pretty close or at the 2% mark as well. Okay, so interesting that they're going to be hitting their mark of 2%. They don't use owner's equivalent rent, which here in the U.S. drives over 25% of how they're looking at the CPI inflation. All right, going back to what Federal Vice Chair Philip and Jefferson said at his speech for the Mortgage Broker Association and Capital Markets Conference Expo of 2024. The three main topics he talked about were the current outlook for the U.S. economy, current stance of the monetary policy, and the dynamics of housing prices and their impact on inflation. So that's definitely something I'll get to and we want to take a look at. Okay, economic activity, as he sums it up, talked about GDP rate of being 1.6% in quarter one of 2024. That was down from 3.4% in quarter four of last year. Right now, expectations are quarter two are gonna be running closer to, back in the twos or even threes. Those are some of the earlier reports. We'll see what obviously happens. But the economy kind of slowing down here in quarter one, but not going negative or anything like that. Was one of the good cases against inflation as opposed to all those hot inflation reads that we had in quarter one. Private domestic final purchases increased 3.1% in quarter one 2024, matching the growth for the latter half in 2023. So consumer spending has been strong. He made that a statement, but it's expected to slow later in 2024 due to this restrictive monetary policy. If you look at the Walmart earnings numbers last year, it's like, okay, it is starting to slow consumer spending, certainly where people are hit the hardest on the lower end of the earnings ladder, but still they're not going away. It's not like a collapse or anything like that. I mean, that's kind of how you read between the lines on the Walmart numbers. Improving supply conditions have supported economic performance as those bottlenecks from the pandemic have now eased. Okay. Employers, labor market highlighted that. That is softening, right? We added $175,000 jobs in April when you had an average of 242,000 over the past 3 months. All right. So last month's number was well below the average that we've experienced now for 3 months. The labor market softening, the labor market steadying out, is one of those things that's good for inflation. If the labor market were to break, that would drive rates down even faster. Break means, though, a lot of people would end up losing their jobs, and nobody's rooting for that. But it is starting to soften, which can help this ease or soft landing. The unemployment rate remains below 4. Labor force participation from 25 to 54 is now higher than pre-pandemic levels. What's happening here too is, you had the era during the pandemic of this entitlement for employees. You're now seeing across the board, really with all companies for the most part, the companies are getting control back of that relationship as this labor market softens. Okay, so that's one of the dynamics I think that's taking shape right now. Job openings declined by 12% from a year earlier, indicating a rebalancing, as he put it, rebalancing of the labor market. Okay. When he talks about the policy, the Fed monetary policy, they maintained at the 5.25 to 5.5 during this last meeting. They're going to continue to stay restrictive. They consider where they're at right now to be very restrictive. When we get to housing here, we're going to highlight some of that. They decided to slow the reduction of the balance sheet, meaning the FOMC, lowering to the cap of Treasury redemptions from $60 billion to $25 billion per month starting on June 1st. The cap on agency securities redemptions remains at $35 billion per month, with excess proceeds reinvested into Treasury securities. Okay, so they're considering this rate that we're at 5.25 to 5.5 very restrictive. and they don't know when they will ease up on that restriction. It's a 90% bet that they won't do it at the next meeting. That bet is made from investors. Okay, getting into the housing sector, and that's ultimately what we care about here. Made the statement that the housing sector is highly sensitive to these interest rates, impacting mortgage rates and originations. Now we've seen for three, we covered it yesterday. For 3 straight years, we've seen mortgage application data year over year over year come down. So certainly it is impacting originations. When we increase prices for the last 12 months, we're at new record prices almost everywhere. And then we're sitting above 7. You're going to see less people be able to afford. That's ultimately the recession of the last 2 years in real estate has ultimately impacted total sales. We're near the floor of the last 25 years at the 4 million sales. Housing costs, which are a major component of household budgets, contribute significantly into inflation calculations. So housing costs, okay, these budgets that people have in their household are contributing significantly to these inflation costs. Those are starting to just creep up on people. Okay, so let me know if in the live chat here, let me know if when you're talking to sellers, if that is it more life change, which I think is probably the bigger bucket, but are you also hearing from folks that it's like, some of the expenses of just carrying this house, maybe more so in a second home, right? Maybe more so the people that you should be targeting on, say, a prop stream, something that we're using to target people who own these second homes. Haley, I'd love for you to just link up prop stream because I've been getting a lot of questions lately about that. Where do you get the data for people that own a second home where these costs might be increasing on them? I can reach out and maybe solve their problem. Maybe go ahead and get them, one of these record prices. Okay, so household budgets are tending to go up on folks that are carrying homes. That's significantly impacting inflation. Chuck Simmons from Real Estate TV says higher insurance rates, particularly as he mentioned there in California and other areas, right? You can see it in Florida for sure. So these areas where insurance costs are going up, if that's a second home and maybe they're doing seasonal, or we talked about some of the short-term Airbnb recently here on the hot sheet, where like the top 10 Airbnb short-term rental markets had occupancy of like 45% on average. It was like between 40 and there was one in the top 10 that had 50% occupancy rate. You start to look at those numbers and the cost to be able to run an Airbnb as your insurance goes up and cuts into your return. It may not make sense anymore. It may make more sense for them to go ahead and exit out of that property and put that equity somewhere else. Okay. Put that equity actually in their bank account. It's not equity. It's not realized money until they go ahead and sell the property. The fixed rate mortgages only common in the US. And he highlighted that's one of those things when people are taking out a 7% mortgage and they think it's insane. Like, this is the only country in the world you can do that for 30 years fixed. So it's a great opportunity. I mean, 7% to be able to get 30-year fixed money is the best deal going in the world. 3% was a make-believe phony deal. Okay, 7% still a great deal. Fixed rate mortgages common in the U.S. slow the pass-through effect of monetary policy on household mortgage payments. The current 30-year fix sitting at about 7%. That's where we've seen it here the last week or so. We dipped below 6 for a moment there and then back up over 7. The average outstanding mortgage rate, though, is about 4%. Okay, so there's a big gap between the current and the average, and this is what's locking up a lot of this activity, obviously. Housing services inflation, going back to that, is derived from monthly rents rather than home prices, okay? So it's one of the reasons I don't like owner's equivalent rent, which I mentioned earlier. If you're just joining me here on the hot sheet, hit the thumbs up. You may want to go back and listen to the beginning where I talk about the UK and how they're about to hit 2% inflation. If we had that, we'd be cutting rates in this country right now. Okay, but it's the way that we look at shelter. Okay, owner's equivalent rent is one of the ways that we look at it. So if we looked at real time rental costs, we would show that it's not only decelerating, but in some areas declining. But there's a huge lag in our data, in our rental and shelter data. But housing service inflation is derived from those monthly rents and not home prices. You often hear Jerome Powell talk about doesn't care that much about home prices, okay? Doesn't even care about home ownership. We talked about home ownership rates yesterday on the hot sheet and how population growth might be the biggest impact on those moving forward. Jerome Powell and the government, the Fed rather, which gets their mandates from the government, doesn't care about home ownership rates at all. Cares about getting inflation back to 2% while holding maximum employment. And the easiest way for them to do that is actually for more people to rent, okay? Especially if they can get rents to be stable or go down, okay? So because our housing service inflation is derived from these monthly rents rather than home prices, we're seeing lagging data. The 3+% we see in inflation right now might be more like a UK closer to 2% if we had real-time data, certainly if we pulled out owner's equivalent rent. Markets rent peaked in 2022, while PCE housing services inflation peaked in 2023 due to its lag. So you see that real-time rents peaked 2022. It didn't show up in the inflation until 2023. So we're still waiting, and Powell said this on his last conference, we're still waiting for a lot of this data to show up that shows that rents have significantly decelerated, okay? And in some cases, even dipped, okay? You see more incentives in some of these areas where there's been a boom in multifamily construction. There's still a whole bunch of multifamily construction to come online. As more of that inventory, it's been the biggest building boom in multifamily ever the last few years. As more of that inventory comes online this year, we're going to have to wait another year to get some of that lagging data that shows, okay, some of these rents are being very competitive and even coming down. The housing sector is crucial for transmission of monetary policy, affecting overall economic conditions. The housing sector as a whole, making up about a fifth of GDP, when you put it all into the pie, he's acknowledging here overall economic conditions is robust. So think about it. If you saw less construction workers, what other supporting businesses would that impact? Logan Motoshami over at Housing Wire often says when the labor market breaks, it's going to be led by the construction workers, and then you'll see a rapid decrease in other positions of supporting roles for those construction workers. Policymakers focus on the totality of the data, not just one sector, to achieve the Fed's dual mandate objectives: maximum employment and price stability. Okay, so it does say that progress has been made. They showed a couple charts here from Chair Philip Jefferson's talk in New York. This is the prime age labor force participation. So you see participation when we're talking about 25 to 54, up now above pre-pandemic levels, as mentioned before. Job opening cuts index, boom, look at that, job openings on the decline. So this labor market is stabilizing. That's good for inflation. PCE and core PCE, while we've had some hot reads the last couple of months, and it's kind of, just getting, it's kind of flattening out here on its way down. This is likely, if UK's indicate, this week is any indication of what our future looks like, this would just be a blip on the radar, and we should continue down here. The last report last week was very good. Measures of household borrowing rates. This one is showing the 30-year fixed mortgage rate in the U.S. So that's certainly gone up as rates have gone up. And then the effective federal funds rate. This basically shows the difference between the federal fund rate and the 30-year fix. We're up over 7, 5.25 on the federal fund rate. We have a 10-year that's closer to 4.5. The spread from the 10-year and the 30-year is improving. If it was a normal spread, we'd actually be below 6%, just about 6% on the 30-year fixed. Market rents and housing services inflation here. You see PCE housing services are coming down. Okay, so the way they are looking at inflation, but it's lagging that of CoreLogic market rents, and it's lagging that of Zillow market rents. So it's not reflective of real-time data sources that they have readily available, like CoreLogic and Zillow. Measures of household borrowing rates versus the average outstanding mortgage rate, which is at 4 or just below 4. So big gap in difference there. And then the average monthly mortgage payment and prime rate, the prime rate versus the actual monthly payment Big difference, obviously, in those two as well, which is holding back more fluidity in the market, more transactions. Most sellers are going to be buyers on the other end. Most buyers today, speaking of home buyers, happen to be Millennials and Gen Z. Those two demos are driving the majority of mortgages in 2023. So we've seen mortgages for 2 years straight go down year over year. We're in the double-digit percentile of mortgage applications being down right now if we look back at same time last year. But it's from no effort, basically no effort or no way that millennials and Gen Z are not making an effort, rather, to do this. Okay. So the new report from Redfin shows millennials and Gen Z are indeed taking out the majority of the mortgages in 2023. If we had a rate that was maybe a little bit more affordable, I think we'd all agree that millennials and Gen Z would make up even a larger percentage than they are now. 39.7% of this year's total mortgages issued to buyers under 35 years of age, and 26.5% going to buyers 35 and 44. So you're looking at almost 65% of millennials and Gen Z saying, you know what, we'll go out and take the mortgage because it's that time of our life. We need to go ahead and do that. Only 26% of Gen Zers are homeowners. Buyers age 19 to 25 have a higher ownership rate than millennials and Gen Xers at their age. So Gen Z jumping in at a higher rate. Gen Z looking to own their own place. Okay. You can find this article on nowbam.com. As for the rest of the year's total mortgage, 16.1% were issued to buyers in the 45 to 54 age group, 10.8% to buyers aged 55 to 64, and then 5.4% for buyers aged 65 to 74. So under 35 at 40%, 35 to 44, again at 25. That's 65%. As these rates go down, expect those two demographics to be even more active in the housing market. There's some of that's sitting on the sidelines just due to affordability. They've decided I'm going to keep renting due to the affordability issues. Millennials and Gen Zers are now aging into home ownership. It's one of the arguments that is going to keep inventory lower over the next 2 to certainly till 2030, rather, I should say. So really the next 5 to 6 years, because over the next 6 years, you're going to continue to see millennials and Gen Zers decide, I'm going to go out and buy that first home, or I'm going to do a move up home. The median age of first home buyers in the U.S. right now is 35 years old. Home ownership becomes financially feasible for buyers in their 20s and 30s. Buyers in these age groups have had some time to save for a down payment and to build strong credit history. Many Americans see real estate as a safer long-term investment than the stock market or other traditional investment vehicles. Okay. It's the only investment that they can live in, by the way. So it's the only one they can use. You can't live in a stock. Okay. AMC stock. While most of, maybe some of those movie theaters might be vacant someday, I don't think they're going to let you just live in there because you own 10 shares of stock. GameStop, all these stocks, these meme stocks, people, right? You can't do anything with them except cross your fingers and hope that they do something crazy, something abnormal, and hope that you sell at the right time. Real estate you can actually use, you can enjoy, you can have it as an investment. You can certainly live in there. 2023 home ownership rates by generation. Here are the home ownership rates by generation. 26% of Gen Zers own their own home in 2023. Millennials, 55%. Millennials still a long way to go here. Coming in at 55%. 72% of Gen Xers, 79% of baby boomers go ahead and have home ownership rate. Yesterday's hot sheet, we did the calculation of exactly how they come up with the home ownership rate. So if you're interested in that, go back and listen to yesterday's hot sheet. If you do the replays here on YouTube, thank you. Love for you to consider subscribing here. Just go down below, hit subscribe, hit that notification bell. If you do the replays on Apple or Spotify, it would mean the world to us if you would consider leaving a review on Apple or Spotify here for the hot sheet. Here are some regional differences in mortgage loan distribution. Millennial and Gen Z buyers took the largest shares of mortgages issued in the affordable Rust Belt metros. That'd be Pittsburgh, Cincinnati, Philadelphia, Detroit and Warren, Michigan. Florida retirement destinations on the other end have the smallest shares of total mortgages going to Millennial and Gen Z. West Palm, Fort Lauderdale, Anaheim, Orlando, Vegas, all between 27 and 32% for share for that demo. Older millennials account for the highest share of mortgages issued in pricey Bay Area metros. So it's tech community, San Francisco, Oakland, San Jose, and then you got Newark and Los Angeles. Okay. So there you go on a report from, this was out of Redfin. We've got these slides carved out for you on BAMX, as well as all of the relevant data that might be a little bit deeper than what we had on the article. Article's obviously on nowbam.com, but if you're interested in using some of this data for your email newsletters, obviously, or communication with your database, just jump into the show notes on BAMX, where we do this every single day, deliver our show notes from the hot sheet each and every single day. You can use it for your local show, your newsletter, your communication inside of your database. If you're not a member of BAMX yet, what the heck are you waiting for? Use code 10%, or use code HOT rather, to get 10% off of BAMX. Use code HOT to get 10% off of BAMX today. We're delivering not only these show notes each and every single day that we do the hot sheet, all of the slides from the hot sheet, but every single Friday we drop content done for you, 3 social media templates, 2 video scripts, an email script, and a blog script every single Friday that you can use, primarily sourced from the data here on the hot sheet that you can use in your marketing and branding. Use code HOT to get 10% off of BAMX. Taking a look now at investor home purchases, another Redfin report. Investor home purchases increased by 0.5% year over year in Q1 of 2024, marking the first rise in nearly 2 years. This is more data. If I've got an investor list, if I work with a lot of investors, I might make sure that this information's out there in front of my list, in front of my leads, in front of my customers, my clients. Okay, hey, first time in 2 years, we've seen an increase in investor home purchases. Often, what does that mean? Oftentimes, there's a trend that follows. So competition is increasing right now for investors. So if you're an investor actively looking, do you want to be on the beginning of that uptick on competition, or do you want to be when everybody's competing against each other? There's been significant gains specifically in the California markets, a shift towards single-family and high-priced home investments, in fact. Increase in investor purchases. Investor purchases increased by 0.5% year over year. It's the first rise since mid-2022. It's noticeable that it's on the uptick and it's not still going down. 0.5%, relatively small. California market surge. Significant increases in investor purchases were observed there, particularly San Jose, where you had 27.8%, and Oakland at 22%. So if I'm one of those 2 markets, I definitely want to highlight that. Those are huge numbers, jump off the page numbers. Profit numbers. Investors are making more profit right now. Typical home sold by an investor in March fetched 55% more than its purchase price. That's up from 46% from a year earlier. Another piece of email marketing I might put out, why investors are making 9% more than they did a year earlier on real estate investments. Certainly people that are thinking about getting into real estate, that might be something that's an eye grabber for them to jump into one of your educational seminars or webinars, or grab an ebook from you or something like that. Increase in single family home purchases 3.9% for investors. Decrease in purchase of townhomes, so that's down 8.6%. Remember that cost of carrying a household, townhomes, HOAs, those things are going up. You see the decrease there. Investments from investors, condos down 6.4%, multifamily properties down 2.5%. I like seeing that investors, these smaller time investors are easing up on multifamilies a little bit, because there's so much competition on multifamily in a lot of these markets with the new big mega complex, the new construction that's coming out, where it's like, do you want to compete with that, or do you want to compete with single family home rentals, where those those prices continue to go up? I like that market a little bit better than I do getting a 2 or 3, 4 unit where you're competing with a mega multifamily complex and they've got all these great amenities outside of you getting one of those 2 to 3 to 4 families in a phenomenal location. Nothing beats phenomenal location. Always buy on location when you can. All right. Highest share of purchases for investors: Miami, Cleveland, Jacksonville, San Diego, San Francisco. Lowest share was Providence, Rhode Island, Montgomery County, Pennsylvania, Warren, Michigan, DC, and Seattle. Largest median cap gains were Philly, Cincy, Virginia Beach, Newark, and Columbus. And then the lowest median capital gains were San Francisco, Phoenix, Las Vegas, Sacramento, and Denver. Biggest increase in investor share, Oakland, Vegas, Tampa, Phoenix, Riverside, California. And the biggest decrease in investor share, Cincinnati, Baltimore, Chicago, Providence, and Seattle. So here's your update there on a recent report on investors. First time, again, the takeaway there was first time we saw a rise in investor purchases, small rise, but first time since 2022. Clearly during looking at the chart in front of you, clearly looking at back at the pandemic, you saw a huge boom. 150% was the peak there. We really saw an increase all the way from, call it 2009 until 2022 when interest rates went up. So expect this number to go up. Right now, you've got probably the final innings of the least competition if you're an investor, okay? There's going to be an expectation that there'll be more competition moving forward over the next couple of years. Here's where investor purchases have plummeted to from, peaking out at 100,000 down to 43,000 on investor purchases in Q1 of 2024. All right. It's your update there. Taking a look here where we're sitting on 10-year, sitting right around 4.402, 4.4 here on 10-year. And then yesterday's 30-year, we finished the day at 7.1. So that's the kickoff the week. Yesterday being Monday, we ended last week at 7.09, kind of just hovering around that number. We'll see, if that number moves at all during this week. Right now, today, anyways, looks like we'll just kind of be hovering around this low 7 mark on the 30-year fix. Expectation is we'll be there for a bit, but we'll see. Maybe we get some big surprise data like the UK is potentially experiencing this week. That's it. If you guys haven't subscribed, please consider subscribing to the channel here on YouTube. Love for you to leave a hot sheet review on Spotify and or Apple if you listen to the replay there. Even if you don't listen to the replay there and you use one of those apps, jump in there and leave us a review. Code HOT to get 10% off of BAMX, where you get access to all of the show notes from the show, the slides, as well as the done for you content each and every single Friday, new courses every single month, and our BAMX community. There is so much inside of BAMX. Best deal in real estate. Nothing is even close. Talk to you guys later today here on the channel. In fact, when we have a new Real Word, which will get posted later this afternoon, new Real Word podcast coming out later today. I'm going to jump in and record that right now. Until then, of course, toodaloo.